My name is Jason Bailey. I'm the Executive Director of the Kentucky Center for Economic Policy. I'm here with Pam Thomas, who is our Senior Fellow. KCEP is a nonprofit, nonpartisan research organization whose work examines fiscal and economic policy issues facing the Commonwealth. Since our founding in 2011, we've produced over 200 reports and briefs and over 500 blogs, many of which have addressed a variety of Kentucky tax issues. I had the opportunity in 2012 to serve on the Blue Ribbon Commission on tax reform that spent about a year doing a similar task to what this task force is looking at in terms of looking at ways in which the tax code could change to the benefit of Kentucky. And Pam, our senior fellow, as you know, served for 21 years staffing the Appropriations and Revenue Committee. So we bring that experience to this conversation and to our presentation today. And we really appreciate the General Assembly's decision to take up an examination of the state's tax expenditures through this task force, as well as the opportunity that Chairman Fleming has given us to testify in front of you today. So I'd like to start by just talking broadly about how we believe the issue of tax expenditures should be approached based on what the research says. And then I'm going to hand over to Pam to get into some more specifics about tax expenditures that we think could be closed or limited in some ways to help generate revenue that Kentucky needs for a variety, or may need for a variety of purposes. So first, just looking at what the vast body of research says, the effect of state and local taxes in and of themselves on behavior of either businesses or individuals is actually pretty small and often not statistically significant. And I think many people in everyday life make assumptions that they carry around, that the effect is larger than the research suggests it actually is in terms of its impact of state and local taxes on behavior. Now, why is that? Well, first, in the case of businesses, state and local taxes are a very small part of the overall cost of doing business, about 1.8% on average if you look at IRS data. And that's really for all business taxes, corporate income taxes, individual income taxes, property taxes, sales taxes, about 1.8% of the cost of doing business. Because it is small, that means that other factors matter more, are more important in making decisions about potentially expanding or locating, including proximity to markets and suppliers, access to infrastructure, quality of the workforce, quality of life in an area, and other factors. It also means because the absolute level of taxes as a share of costs is fairly small, the difference between states or between localities is also quite small. Also, when it comes to businesses, it's important to remember that more than 80% of the job creation in any state in a particular year comes from businesses already in the state choosing to expand or startup companies. So in the case of expansion, these are businesses, since they're already here, that are already operating within the current system of taxation and other rules and regulations. So they already see and are taking advantage of opportunities within that environment. And in the case of startups, the income tax structure, for example, makes less of a difference because they're typically not profitable in the early stage, often reinvesting profits in marketing and equipment and other expenses, and so aren't necessarily subject to income taxes. So the share of jobs in a state coming from an out-of-state company expanding into the state are a very small share of the jobs, and from a company actually picking up and moving is even smaller, about 1 to 4% of jobs. So the actual universe of businesses you're trying to influence with tax policy is actually quite small. Then when it comes to individuals, levels of migration are smaller than are sometimes imagined, and the rigorous research shows taxes at the state and local level have a small or even negligible impact on those decisions. The majority of people do not move out of a state in their lifetimes. Only 1.5 to 2% migrate across state lines each year, but that ratio actually seems to be declining in recent decades, and the share of people who are moving between states. The people who do move the research shows, are motivated primarily by things like a very specific job opportunity, a family consideration, being closer to family, a weather, climate interest, or housing costs, which do differ a lot between states. Taxes are not a big factor. And higher income people, millionaires, actually migrate less than the general population because they tend to be embedded in their communities. They have jobs. They are often older. They're more likely to be married, have kids in school, have family responsibilities, own a house, own a business in a location, all of which discourage migration. The other point I think that's important is that states like Kentucky have constitutional requirements for a balanced budget. So when you reduce taxes in the urge to be competitive, there must be a related cut in services. And there is strong evidence that public investments in areas like education, early childhood education, K-12 education, higher education, infrastructure, ranging from modernized roads and bridges to broadband, all increase the productivity of the workforce and therefore the strength of the economy. So there's a lot of discussion about competitiveness, but most growth comes from within a state. Taxes are not a strong contributor to decisions about the small amount of growth that comes from outside the state, and taxes contribute to growth primarily by building a strong foundation for economic development through these public services that are cost-effective. That's why we have taxes in the first place. So it's important to be, I think, wary of so-called business climate studies or business climate indexes. There's one by the Tax Foundation that ignores the extent to which your taxes go to paying for public services. They do not have, the Tax Foundation study, for example, any documented link to economic growth. If you look at that ranking of states, the top 3 states are Wyoming, Alaska, and South Dakota, which if you add their populations together is about half the state of Kentucky in those 3 states. So we do not see people or businesses flocking to Wyoming, Alaska, and South Dakota because of their tax structure. So another important factor to keep in mind when talking about tax expenditures and potentially ending some is the impact on the overall equity of the tax system. And the equity matters for a few reasons. One is simply an issue of ability to pay. A smaller share of income goes towards making ends meet the farther you go up the income scale. So the ability to pay taxes rises. The second important factor here is that we have an economy where most of the gains of economic growth are going to the people at the top in terms of rising wages for executives and rising income from capital ownership. The wages for low and middle income Kentuckians and frankly Americans has been stagnant or even declining in real dollars for several decades now. So to the extent our tax system asks less of those with more and more of those with less, the rate of revenue growth will be slower and it'll be harder to maintain investments in public services like education. And in Kentucky is this study that a new version just came out from the Institute on Taxation and Economic Policy shows we have a tax system that is somewhat regressive overall. So it's slightly progressive, meaning you pay more in taxes as a share of income from the bottom to the middle, but then it declines as your income rises, and the wealthiest 1% actually pay less in overall state and local taxes than other groups. Because most of our revenue comes from income taxes and sales taxes, about 75% of what we collect, the extent to which we rely on one or the other very much influences the overall equity of the tax system. And this graph just breaks out the previous graph looking only at sales taxes and income taxes. Sales taxes is the dark blue bar, income taxes are the light blue bar in Kentucky. You can see that our income tax, even after the change in 2018, is slightly graduated, slightly progressive, because we have a low-income credit and a few other things, so that it rises with income to a certain extent. The sales tax, though, is the opposite of that. It's very regressive. And that's simply because for lower and middle income people, they're more likely to spend pretty much all of their income to make ends meet. Therefore, all of it is subject or could be subject to the sales tax, whereas higher income people save a portion of their income. So Because of what I mentioned earlier about how income is accruing primarily to people at the top, any tax changes aimed at reducing tax expenditures that shift from income to sales taxes will shift the equity of the tax system onto middle and low income people and can slow the rate of revenue growth, leading to cuts in those important public services. In addition, when thinking about tax expenditures, it's important to keep in mind that they inherently have a higher status than budgeted appropriations in the way that we and every other state spends money. So spending through the tax code is really just like spending on the budget, in that it's a way that we allocate resources to a particular end. But tax expenditures come off the top. Before the first dollar is appropriated in the two-year state budget, tax expenditures have first dibs, if you will. Budgeted appropriations are for 2 years and go through a somewhat arduous process, as all of you know, in identifying priorities and often making cuts. But tax expenditures usually, unless they have a sunset date, exist in perpetuity, are never revisited or evaluated. And except in task force like this are community. And the third issue is that advocates of various kinds increasingly turn to tax expenditures when they want money spent in a certain way, because it can be argued it's just a tax cut rather than a spending increase, and that can lead to things that would probably not pass muster if included in the regular budget, becoming a way that we spend money. So there's an extent to which they can grow out of control. So the overall approach to tax expenditures that we think should be taken, given that taxes themselves often play a small role in actually furthering economic growth, except to the extent they fund crucial public investments. The equity of the tax system matters, both for fairness and for revenue, and tax expenditures are at risk of expanding more than our budgeted expenditures. The goal should be to limit them as much as possible. And we believe there are two primary exceptions to that. One is that they've been shown through rigorous analysis to be cost effective, and not only that, but to provide a better return on investment than the on-budget programs that they displace, because they inherently do displace some sort of on-budget spending. And second, that they're needed to enhance the equity of the tax system, as mentioned before. So, just to run through just two examples of this, the sales tax on groceries is a good example of a tax expenditure that should be kept because it enhances the equity of the tax system to keep them exempt. Everyone has to eat. Food makes up a larger share of consumption for people with less than it does for people with more. And data from the Bureau of Labor Statistics Consumer Expenditure Survey shows lower income people spend a larger share of their food budget on meals at home as opposed to eating out, which we do tax. So a sales tax on groceries is very regressive, even though we exempt purchases made with SNAP or food stamps. Many low-income people do not qualify for SNAP. SNAP is only a supplemental support. It's not intended to provide the full family grocery budget. So the cost of a sales tax on groceries is about 10 times higher for the poorest 20% of Kentucky families than families in the top 1%. And we believe for that reason it should be avoided. That's why 31 of the 45 states that levy a sales tax exempt groceries. And in fact, the movement among states has been to expand the exemption, not move the other way and get rid of it. In the last 20 years, Georgia, Louisiana, North Carolina, South Carolina, West Virginia have all exempted groceries from the sales tax, while Virginia, Tennessee, and Arkansas have reduced their rates on sales tax rates on groceries in the last couple of decades. So we think this same rule would apply to other essentials like utilities and prescription drugs, which we should continue to exempt. There are plenty of better options for raising revenues that don't have the harmful regressive effects of those items. And to the second point about tax expenditures that have a track record and a strong base of evidence that they are cost effective, the earned income tax credit would be a good example of that kind of tax expenditure. Kentucky does not have a state earned income tax credit, but 29 states do. And there's a growing body of research that links state earned income tax credits to higher infant birth weight, lower rates of premature birth, better test scores, more enrollment in college, and more earnings later in life. So the benefits of this extra cash to low-income families is well substantiated in a wide variety of peer-reviewed studies. So it's rare, though, that there are tax expenditures that have the level of documentation and study that the Earned Income Tax Credit do. In fact, many of them have had very little study at all. So at this point, I'm going to pass it off to Pam, who's going to go into more specifics about our current tax expenditures and some proposals we have for limiting or ending some in order to generate additional revenue.
Thanks, Jason. I'm going to start with the individual income tax because when you look at the primary taxes we rely on, and as Jason said earlier, that's the income tax and the sales tax, and you look at both of them over time, it's fairly clear that the income tax grows better as our economy grows. And so as a state government, one thing that you need to be thinking about is if we have a revenue system in place, we want that revenue system to generate the revenues that we need without us having to come back and increase rates or other things. And so I want to start with that. There were several exemptions that you took away in 2018. Of course, you all know that. But there are a few others that we think deserve additional consideration. And one is the retirement income exclusion. As it stands, and I say retirement income, I know some people think that it's pension income, but it's not. It's all retirement income. It includes 401ks. And the history of that is really interesting in understanding where we got. I'm not going to go into it today. But it started out as just an exemption for state employees, and it came into being when those systems were created. And it morphed over time, part of it because of a court case, and the other part of it because the legislature had a lot of money and there was a fairness issue, or there was a perceived fairness issue. I'm happy to give you more information about that if any of you are interested. But in this circumstance, I do think the history is very important because it didn't happen all at once, and it was there originally for a specific purpose. In any event, it's very, very broad-based. It applies to everybody, no matter what the overall income level is. And I'm going to use myself as an example because, as you heard from Jason, I'm a retiree of state government. And I think I should be paying taxes on my retirement income, honestly. I mean, I more than half of my income right now is exempt from taxes, and that's not fair, and that's not right. And so I just say that up front. That's not in my notes here, but I believe that. But the other thing that you need to think about with the pension exclusion is it's going to grow over time. It has grown, and if you look at the graph here on the slide, that takes us through 2015. And the Kentucky State Data Center is estimating the Kentucky residents over 65 will increase by 44% between 2015 and 2030. And what that means is an increasing amount of your income tax income is going to be retirement income, and you're going to see a shift from earned income to retirement income, and what that means is that exemption is going to get bigger and bigger. I know you reduced the level this year, and that reduced it overall, but if the policy goal is to help low-income retirees who are on fixed incomes that aren't going to get more money, then it would make some sense to consider phasing it out at higher income levels, because there's not really a reason why, like I said, I should get this exemption. Because I can afford to pay the taxes, and if the goal, like I said, there is an assumption maybe that retirees are all low-income people, but that simply isn't true, and that's especially true as more and more people retire. So that's the big one I think that's really left there that you could consider addressing in a different way going forward. The other option here is to cap the itemized deductions, and itemized deductions are primarily used by wealthier people, and by doing that, you're not taking them away, but you are making the system less regressive, and you will allow it to grow over time as the economy grows. The other thing, these studies that are mentioned on this slide both question the effectiveness of our economic development incentive programs, and the true answer is that nobody in Kentucky has the data to analyze whether these programs are effective or not. You have the ability to get the data to analyze the programs, because you write the laws that create them. What you get told is that, well, if we collect data, then they won't come here. It's proprietary business information, but other states do it. And so you can't really know how effective the programs are if you don't collect the data and have the information to do the analysis that is necessary. As Jason noted earlier, taxes are really a very small, state taxes especially, are a really small expense for most businesses. And in Kentucky, we do something that's a little bit unique in that we erode both of our corporate and our individual income tax bases with these programs. You all have heard of the wage assessments. That's essentially the amount that gets withheld from the employees' paychecks that should get turned into the Commonwealth of Kentucky, but the businesses get to keep them as part of the economic development incentive programs. And the reason that came in, and I can say this because I was there when it happened, is because the company said, well, you know, a lot of us don't pay taxes in the early years when we're starting up because we're starting up and we have a lot of exceptions or, you know, deductions, and so we need another way. And so Kentucky actually was the state that originated that process. So I really think that these programs need more scrutiny. You need more data in order to analyze whether they really work. And if they don't, it's a lot of money. And if they do, you know, then you'll at least know that. Now this is the slide where I can get on a soapbox, and I'm really not going to. Just, if I do, Jason's then given permission to kick me. There are some business tax breaks that should be really considered and looked at again from an analytical and research standpoint. The first one I want to talk about is the film industry credits. And you may remember that the commissioner or the secretary testified during the last session that the program should be eliminated because they didn't believe it was cost effective. And it has been suspended, and a lot of states that had these programs over the last several years have suspended them or ended them because they've shown that they aren't very productive and they aren't effective in accomplishing the goals that the state was intending to accomplish with them. And the program has been cut back, and it has been put on hold, and it now has $100 million caps. Well, $100 million is a lot of money. Even still. And it has been made non-refundable, and that's going to cut back on it a little bit. But you all may remember, I think there was almost, was it $350 million of projects that were approved in April of 2018. So that's going to play out for several years to come. You're going to see that hit for several years to come. But really, I think that's one that deserves a looking at to say, are we really getting the bang for our buck on that? The next one is the angel investor tax credit, and those are the ideas are good. It's a way to put people wanting to start new businesses with people who have capital. But in Kentucky, our program is very, very overbroad. They don't have to be new businesses. They don't have to be startup businesses. They don't have to be businesses that have exhibited any trouble in getting capital in traditional means. And so, at the very least, it's way too broad, and it deserves, I think, further scrutiny to determine whether you're getting bang for your buck there. The last specific program I'm going to talk about is TIF. It's a very costly program. It has no job creation requirements, and Kentucky took essentially what was a pretty good idea that some other states were using and put it on steroids. And when I say that, the original purpose of TIF was to take land in urban areas that was blighted and that had legitimate infrastructure needs that were cost prohibitive, and so developers wouldn't consider redeveloping that land. And so the idea was, okay, well, if people will come in and redevelop this land, we can see the increase in the property tax value. We know that it was maybe $10 before, and after development it's $1,000. And so the difference between those two is the amount that we'll give back to the developer to let them recoup their costs of doing the development. It's pretty easy to measure that, and it's really hard to gain that because you can see the results. Well, in Kentucky, our property taxes are pretty low, as you all know. And so the Kentucky included the corporate income tax, the individual income tax, and the sales tax. And there is an analysis done on the front end that it is going to be a net economic benefit, but no analysis is ever done after the fact to determine when things change and things actually happen, if that's the case. And businesses can move from outside the TIF district already in Kentucky to inside the TIF district and count as new revenues. And so in effect there, you're actually losing revenues you had. So I think that's another program that deserves more scrutiny and analysis to determine whether you're really getting bang for your buck and what you want. I've written more on all three of those that I'm happy to share with any of you if you want more information on it. And then the last thing that I want to say about economic development programs is the other ones that do have job requirements. The average wage that is required to qualify is $10.88 with benefits. That's the average wage, which means that if you've got a few high-income people skewing that average, you could have a lot less, and that also includes benefits. And in Kentucky, that's extremely low in many parts of the state, especially in the urban areas. And really, if there are going to be incentives provided to businesses, they should be given incentives to provide a living wage that allow people to support their families. And I think that all of those programs should be revisited periodically just to determine that they're still meeting the requirements. And so then the last thing that I wanted to say here is that the return to a three-factor apportionment formula, you just moved to sales only last session. And again, I'm going to be real brief here, but the history is important here. The reason the three-factor formula was developed to begin with is they were trying to think of a fair way to measure the way that corporations use assets in a state or use services in a state. And they picked property, payroll, and sales. So let's think about it. The two things that are predominantly in the state that demonstrates your use of resources in the state are your property and payroll. And those are the two things that were removed from the formula before in the last session. And so when you think about fair measurement of how a corporation is using the assets in your state, the two things that really do measure that have been removed. There are still many exemptions remaining on sales tax that should be revisited, and there's several listed on the slides. I'm not going to go into any of these except to say that one thing to think about where I think there is some substantial money is you expanded it to services related to the sale of tangible personal property. So if there's a tangible personal property item and then services are attached to it, you're taxing those services. That creates bifurcation for a lot of businesses in some questionable areas. If you just tax those businesses on all of their sales, I think there's pretty good money there, and also you could deal with some compliance issues probably. But there are other ones listed here. The other thing I want to mention is the business-to-business purchases and pyramiding. Built within the sales tax formula, or the sales tax itself, you think about manufacturing of tangible goods. And you don't want to charge taxes on the things that go directly into that chain of production that result in an item that's going to be taxed. But the way folks talk about it now is a lot broader than that. It's called business to business, which is broader. It's basically any expense that a business has results in pyramiding. Well, when you talk about landscaping for a manufacturing company, it's not in the chain of production. So be really careful as you're thinking about what is an exemption that fits within the nature of the tax, and what is really another way to try to figure out how, to get out of the payment of taxes. What is really in the chain of production and what isn't? Because under that argument, any sales tax a business pays, even if it has nothing really to do with their production, should be forgiven as business to business. So it's really a much narrower category when you think of that. And then I think this is my last slide. You've heard about the state property tax rate before. As part of House Bill 44 in 1979, the state tax rate was frozen, or the growth was, real property was frozen at 4%, and the rate has reduced from 31.5 cents to 12.2 cents over the intervening time. If you simply froze that rate where it is, you would prevent further erosion of the property tax collections as the property tax base grows. The second one is the hospital provider tax, and I know you all have heard a little bit about that because it was frozen from, let's see, it was established in 1994, and the revenues rose from $72.6 million in 94 to $183 million in 2006, which is when the hospital rate was frozen. So they've been paying $183 million since then. If that rate had just been allowed to grow over time, there would be about almost just a little under $100 million more in revenues from the hospitals, just if they had paid on their revenues as they were growing over time. And then the last thing that I'm really going to talk about is advanced deposit wagering and instant racing. If you go, and you can look at this information on the Horse Racing Commission's website, all of the growth in the horse, in the betting part of horses is coming with advanced deposit wagering and instant racing. The live handle on the track is going down and off-track betting is going down. And these two areas are taxed at lower rates than live track betting and off-track betting. And ADW is only taxed at 0.5%, and every year you see growth in that because there are benefits to people betting that way. It also reduces the on-track handle because you can be at Churchill with an ADW account, bet on ADW, not live at the track, which keeps the live handle down, which keeps them at the lower tax rate. And also most of the money from ADW and instant racing goes back to the horse industry. So the proposal here would be not to change that at all with the existing rates, let them benefit from the growth in the existing rates, but make those rates same as they would be for betting at the track, so at least 3%, and then have the rest of it come to the general fund. As you know, there are more and more instant racing machines that are being installed. Churchill just opened a facility there. And there's double-digit growth in that every single year. And so missing out on the taxation of that, it's a fix that you should consider. And that was really all I had.
Thank you, Ms. Chairman. Oh, yeah.
Thank you very much. Apologies for not recognizing you earlier, because I knew you were going to come here and talk about this, and also appreciate your service for 21 years. I don't think our paths crossed, but I heard good things about you, so thank you very much for coming in and making our presentation. I just want to open up to my colleagues. If you all have any questions for Ms. Thomas or for Mr. Bailey? Any questions at all? Mr. Representative Peter?
Thank you. Really quickly, go back to House Bill 44, and can you flesh that out a little bit on any recommendations? I know that's not tax expenditures, so if you can make it brief, but just flesh it a little bit.
Are you talking about the state tax?
Yes.
Yeah. So what happened in House Bill 40?
Not what it is, but recommendations on what to do with it.
Oh, well, what I recommended was to just, or what we recommend is to just not let the rate fall any further. In other words, the way that it works now is the assessment base comes in. If the assessment base grows, the rate is reduced so that not more than 4% revenue from real property is produced in any year.
Understood. Are there any projections of what that would result in?
Well, it would really depend on how the assessment base grows. And
Right, and you know, the assessment base has not grown to push the rate down in recent years because of the Great Recession and the slow recovery. But as the economy grows, and we hope surpasses that at some point, the rate will start going down again unless we freeze it.
No projections at this time, though.
It won't be a revenue raiser immediately, but it will prevent further decline from that tax.
Ms. Allen?
Thank you, Mr. Chair. Bam, I'd be very, very curious as to see the rest of the information that you have mentioned that you have access to on the film tax credit and the angel investor tax credit, and why those programs you think need a second look. Actually, you might as well throw tips in there as well. I'd like to see that too, please. Where the information that you have that led to these thoughts that you have on this, where did that come from, and how did you accumulate that, and also
On those three programs?
mm-hmm.
Well, it's based on kind of looking at what other states do with those programs and the conditions under which they apply, and it's looking at information over the 20 plus years that I was with the legislative staff, looking at these programs and analyzing them and answering legislative questions about them. The information about the film industry tax credit and the number of projects that have been approved are on their website. You can get that information there. But it's all
Kentucky, are you speaking
Yes.
specifically?
Yeah.
Okay.
And then there's quite a bit. There's been quite a bit actually written on a national level on the film credits because they were a big thing and then they weren't. Which I can send you some of that information too if you'd like. And then with tax increment financing too, there's quite a bit that has been written about that on a national basis, which I can also send you.
Well, I find it interesting because I'm pretty familiar with all three, probably the least of which would be the TIFs. And there are other conclusions that could be drawn from some of the information that I've seen. So I'd be, like to be enlightened as to your position and where you got that information and the data, assuming it is our data and not signed one way or another. Thank you.
Representative Tipton.
Thank you, Mr. Chairman. Thank you all for coming today. I forgot, Representative St. Ives, I forgot to hold it down. Thank you all for being here today. A couple of questions. You mentioned in your presentation about the Earned Income Tax Credit. You used an example of $3,000, like 17% increase in kids' annual earnings as adults. You mentioned that there are currently 29 states that have an EITC. Could you share what ranges do these other states have in their current EITC?
Usually what states do is set the EITC as a percentage of the federal EITC. So a state may decide to do a 10% EITC, just meaning that whatever EITC you get on the federal level, you get 10% of that. So if you got $3,000, federal level, you may get $300 at the state level. They really vary. I think the largest may be close to 50% of the federal, but there are some very small ones that are more like 5%. So it really depends on what a state can afford in the context of its other programs. But it's certainly the case that more and more states have done that. In the federal level, there's also a conversation about potentially, including on a bipartisan basis, expanding the federal EITC to include more folks because of the kind of research that has come out about its effects. Even small amounts of money for low-income families with children can make a big difference. So it really varies. We can get you, though, a list of exactly what each of those 29 states do.
One more.
You also referred to the retirement income exemption and suggested support phasing that out for higher income people. Do you have a specific threshold of what income level you're referring to there on that exemption change?
Well, you could start, in a dollar for dollar basis. You could set that kind of wherever you wanted to, but if you could start at the current level, which is $31,110, and phase it out on a dollar for dollar basis up to where it's completely phased out, or you could use a little bit higher level. Just kind of you could base that on whatever made sense.
Yeah, my question went more to what income level of the taxpayer would you apply that phase out to?
Well, yeah, it would be total income, not just the pension, but
Yeah, that's usually the way it's done, is sort of looking at all income from all sources except Social Security, which continues to be exempt, as it is in Kentucky, and choosing a level. We don't have a level. I think you have to trade off, though, the revenue that it would generate from the impact on those retired folks. But it is important to note that many states don't exempt retirement income at all, or they exempt a couple $1,000 or $3,000. Kentucky is unique, and the real challenge is the point that Pam made, that retirement of the baby boomer generation is a huge hit. We're moving from taxable income to untaxable income every day. Large numbers of people, that hurts our revenues significantly, and so it is something we need to look at. We would like to see it done in the fairest way and to make sure those folks who are of more moderate incomes are fully protected.
Thank you.
Representative Tipton, I believe the threshold, according to my friend Representative Wayne, 30th District, he put in his proposal 35,000. I think that's what it is.
It is
So any amount up there, dollar for dollar, Ms. Thomas says, will be taken away from that 30. So if you look around 25,000 as the threshold, if somebody earns 45, then what we put in at 31, there's a difference, obviously, with that. So I think it's around 35.
He did 35, and that's under the option of married filing separately on the same return. So that's 35 per person if you're in a couple that's married. But again, that's only when it starts to phase out. So it would fully phase out into that scenario at 70,000 per person.
I have a question. I know Representative Petrie has a question. Mr. Bailey, you mentioned in your presentation on the EITC that these 29 states, some of them might tie it to some type of health benefits or some type of tie with that. I want to see if I heard you correctly, because that's an interesting concept, and particularly when it comes to what we see from a health statistics and rankings, that Kentucky ranks very poor in quite a few categories when it comes to health, particularly in the lower income. Is there, I mean, did I hear you correctly? And if so, can you give a little example? If not, just send us along that information to Representative Tippin you mentioned.
There are a number of academic studies that have, because the ITC has been around for a while, that take a longitudinal look at the impact of children and on their health, on the health of, again, on sort of the premature births, on birth weight, and then later on in life test scores, earnings in life, likelihood to be employed, etc. And the studies indicate that even small amounts of additional income in a household when a child is young can have long-lasting positive effects. And that's what an EITC is. It is it's additional once a year or cash infusion into a family. So that's really what I was referring to, was academic research about the link between those additional cash benefit and the long-term effects, short and long-term effects on the health and well-being of the children in the family.
Right.
So we're glad to share those with you.
Okay. Representative Petrie?
Thank you. Big picture for a moment. Assuming that this task force is supposed to issue a report by the end of the calendar year on how to approach tax expenditures, how to analyze them, and big picture recommendations about how to deal with them in the coming future, 40,000 foot level, any recommendations? I know we dove into several specifics, but overall recommendations.
Yeah, I mean, we think, I guess our philosophy that we think should be brought to it is that tax expenditures should be limited as much as possible, except for those that, again, have been shown through rigorous research to be cost effective and or are needed to help improve the equity of the overall tax system. So that's sort of a theory. How you apply that to the current tax code, I think, would be a couple of things. One is to get rid of some that aren't working. And we put out some ideas. Other folks may have other ideas, but we could take action now to eliminate or limit some. We put out a list for your consideration. And then I think there is an approach that should be taken to future tax expenditures. Every session, as you all know, you hear these pleas for folks to have a new tax expenditure created, a tax break for this, that, or the other. And it is important, I think, to be wary of those requests. Again, they have priority in the budgeting process. They come off the top. They exist in perpetuity. They are never usually revisited. They certainly are debated within the budget process usually. And so there should be a skepticism toward those. And those that are created should have built-in systems for collecting data, for doing analysis, for sunsetting them on a regular basis so that they go away unless somebody fights or is able to build the support within the legislature to keep it. So I think there are some things that you all could put moving forward as well to ensure that tax expenditures receive more scrutiny than these occasional task forces, which are good in studies and commissions, but there needs to be something systemic built in that automatically evaluates and eliminates unless the tax expenditure can be proven to be cost effective.
Sunsetting has been discussed before. Dealing with those that are already in effect, retroactively sunsetting or applying some kind of system, as well as those prospectively created. Any recommendation or thoughts from your group about including expenditures in the budget process every 2 years so that the General Assembly looks and has those things put in front of them rather than just being left with a net of what you're going to be dealing with, not what you could be dealing with?
Well, yeah, I mean, you can't have revenue and expenditures and appropriations in the same bill. But what you're talking about is evaluating as part of the process, right?
Well, yes, because
Yeah.
as you will know, and being on this side of it, you're blinded in some senses with the top 10 billion, and you're given 10 billion on the bottom to deal with, but you never see this.
But you don't see what goes into the revenue estimate. That's right.
You never see it.
Right.
And so trying to deal with it prospectively and make sure it comes in front of the legislature every so often rather than periodically with a task force, just like you mentioned, has there been any thought put into making that available? I know it's not part of the budget, but making those expectations be public every 2 years so we have to see them every 2 years.
Well, and that's what sunsetting would do, is that in a particular legislative session, you may have a slate of X number of tax expenditures that are going to go away if the legislature doesn't proactively pass legislation to extend the sunset or reauthorize. So that would be the de facto situation if there are sunset dates in place. And there have been a few instances of that in the past, where the legislature, I believe we used to have enterprise zones that had a 20-year sunset date or something. And my memory is that when that 20-year came up in that session, the legislature let it go. Now another program was created in its place, I believe, but regardless, that puts the onus on legislature to proactively take that action.
And one thing that I wanted to say, in addition to what Jason said, is that if you move in that direction, you have to do a couple of things in order so you can effectively evaluate whatever it is. And one is you have to know what the purpose of it was to begin with. I think one of the frustrations you're probably facing now is you don't really know why a lot of these things exist. And then the second thing is you've got to have the data in order to analyze the effectiveness, which doesn't exist in a lot of cases now.
Very, very quickly, on that, how many tax expenditures do we have? 600. Okay. So if we try to let the sunset provisions go through over time, we'll be here a couple of generations before we get through all of them. Thank you.
It's called lump sum. Mr. Bailey, Ms. Thomas, thank y'all very much. I don't think we have any more questions from the committee, but thank y'all very much for coming here and making your presentation. Mr. Harris,